Hey guys, welcome back to another video. My name is Josh. In today's video, I'll be sharing with you a calculator that I created that looks at the returns of property versus the returns on investing in the stock market. And over a period of time, it looks at which one is a better choice for you. Now, this calculator looks at the returns on a house that you're living in, not necessarily an investment property. The reason why I created this calculator was because I was looking at buying my first home, and a few months ago we did. And using this calculator, it's helped me internalize how much returns I would expect to receive over the duration of my mortgage repayment, right? So, and it looks at the alternative of what if I had invested that money that I would have put into a house and repay the mortgage with, investing that in the stock market and seeing how that will do over the long term. So this calculator is obviously just a theoretical exercise. We'll be using a lot of assumptions over the long term. As you know, assumptions do change over time. So the numbers that I may be getting by the end of this exercise might be completely useless. The second point is that investing in a home to live in has a lot more qualitative benefits than the numbers might suggest. So investing in stocks might not be an option if you are raising a family. So investing in a house or a first home to live in might actually make more sense. So this calculator is purely just an exercise for you to think about what the opportunity cost would be if you had invested in stocks instead of buying a first home, or if you had sold your stocks and bought a first home, what kind of returns you generate over the long term. So over here is the property versus stock investment calculator. There's two sets of assumptions that we'll need to input in this calculator. The first one is the home ownership assumptions, and the second one is the stock investment assumptions. The only thing that you can change in the spreadsheet are the green cells. Anything else is protected, and the reason why that is so that you don't accidentally delete something and the whole calculator fails. So for this exercise, what I'm going to do is I'm going to use the average house price and look at average numbers just to show you what it would be like if you had bought an average house in New Zealand to live in. So the first thing that we're going to do is find the average house price in New Zealand. As of September 2023, it is currently sitting at $899,256. I'm just going to round that up to 900,000 as our average house price that we're buying. The next assumption is LVR, or loan value ratio. This is the amount that we're borrowing of that 900,000. So in most cases, people are going to borrow 80%. If you're borrowing more than 80% of the house value, you're going to be hit with a low equity margin. Basically means you pay higher interest rates because you're borrowing more. The banks deem you to be risky, and so they'll charge you a higher interest rate. And for that reason, a lot of people mostly borrow at 80% LVR. For the mortgage rate, I have here the mortgage rates as of 11th of October. That's when I made this table over here. And I'm going to use the average rate of 7.03. Now, I do want to touch on this a little bit. The rates vary depending on the duration. As you can see, the 6-month rate is higher than the 3-year rate. And if you work with a mortgage broker, you might actually be able to bring the rates down. So for example, I did work with a mortgage broker from Mike Pero. His name is Nigel, and Nigel helped us negotiate with different banks to give us the best rate. And we actually got an interest rate that was better at a different bank from when we initially applied the mortgage with, and he was able to negotiate the rates down. And on top of that, he was also able to give us a cashback offer, so that helped us, pay off some of our mortgage quicker. So if you're interested in getting in touch with Nigel, I'll leave a link down below as well. You can contact him that way. All right, for the mortgage duration, I'm going to use 30 years because that is the typical mortgage duration. You can play around with a shorter duration, but we'll get to that a little later. Home improvements assumption over here is referring to the cost that you'll need to spend when you move into a house to make it livable. So for example, if you bought a house for 900,000 and the bathroom is broken, you need to spend 30,000, then you input that over here. But for this case, I'm just going to put 0, assuming that there's no improvements, but that's up to you to change and play around with. In terms of rates, insurance, and other costs such as life insurance and whatnot, income protection, you might put in a number that is relative to your house price. For this situation, I'm going to use 6,000 as that is about average across rates, insurance, property insurance, and income insurance, life insurance, whatnot. For the property returns, what I'm going to look at are the returns over the long term. So house prices growth over a 30-year period between 1990 and 2023 was an average of 6.1%. So I'm going to use that number here, 6.1%. Seems pretty conservative because house prices tend to double every 10 years historically. So that's about a 7%. 6% sounds about right. It's not too far off from 7% after all. All right, so these are our home ownership assumptions. And on the right over here, we have a waterfall chart showing how much the initial equity is, our mortgage repayment, capital gains over 30 years, and our closing balance of 5.3 million. All right, but we haven't entered the assumptions for stock ownership yet, so it's not complete yet. Let's take a look at stock returns. Over the long term, the S&P 500 has generated a return of about 9% on average, and that's before taxes, of course. By the way, this exercise, we have not considered taxes in home ownership assumptions and stock investment assumptions because tax is more of a personal situation, right? Your tax rate might be different from mine. So, well, we're going to look at just before tax returns, right? So for this example, let's just use 9%, and that's the S&P return over 30 years on average. For the rent per week, I've looked at that. The average rent in New Zealand and in August, the August rental price index from this article from Trade Me Properties is $620. So I'm going to use the weekly average rent of $620. And over here is the cost inflation input. So what that refers to is how much your rent will increase over time due to inflation. At the moment, it's sitting at about 3.35% per year, and that is based on a News Hub article over here saying that average rents rose 83% between 2003 and 2022. So that's a period of about 19 years, and I say that's a pretty conservative assumption, considering that inflation's probably gonna sit around that level over the long term. So once we've entered this number in, we have the results of how much you would generate over 30 years if you had to invest that money into stocks. This looks at initial equity of 180,000. So that is the initial deposit that you would have put into buying a house. The net cash invested refers to how much you would have saved if you had not have to pay a mortgage and pay rent instead, and investing that cash difference. And over 30 years, you'd be $408,000 better off, right? And that net cash is invested, and over the long term, over 30 years, you'd generate $4.8 million in capital gains. And that leaves you with a closing balance of $5.4 million. And that is actually slightly above the returns that you would generate over the 30-year period for buying a house, right? And you can see this chart over here. What's interesting to note is that the stock investment option underperforms the home ownership option for a very long time until closer to that 30-year period where it slightly overtakes it. So the biggest gap between home ownership and stock investment is probably around this area over here of around 19 to 20 years. And after that, the stock investment option basically overtakes the home ownership returns over the long term. And the reason for that is leverage. So I've created a chart over here that looks at how leverage boosts property returns. If you borrow 80% of the house value or an 80% LVR, you're basically only putting in 20%. And a 5% increase in property prices will increase your return on investment by 25%, because 5 on 20 is 25%. However, if you have borrowed 40% of the house value or a 40% LVR, a 5% increase in your house price means an 8.33% return on your equity of 60%. And if you have 0% LVR or you don't borrow any money, then a 5% return on your property means a 5% return on your equity, right? So obviously the numbers mean that if you borrow more, the returns on your equity will be higher than if you had borrowed less. So over time, as you pay off that mortgage, your LVR naturally drops as you pay off more of that principal, and that means that over time your returns on equity will get lower and lower, and that is why we see stock investment outperforming home investment towards the later years. Now you can play around with these assumptions just to see how things will change. So for example, let's say I reduce my mortgage duration by 10 years to 20 years, then the numbers will be slightly different and home ownership will actually be better off than buying stocks. So that's an interesting thing to look at. Another interesting one to do is if I increase cost inflation to say 5%, you're actually slightly worse off investing in stocks. The reason being is because when you invest in stocks and not buy a house, you have to pay rent, and rent increases with inflation over time. So high inflation equals higher rents over time. But if you are buying a house, you only pay back your mortgage repayment amount, and that amount is fixed over that 30-year period. So it's not impacted by inflation. Your rates, insurance, and other expenses are increasing with inflation, but those numbers are much smaller than how much you would have to pay if you had to pay rent. So that's why the stock investment option or outcome result is lowered because of higher cost inflation. Another scenario that you might want to look at is changing the stock returns so that the home ownership and stock investment result over the long term matches. So in this example, what I'm going to do is I'm going to revert back to our original assumptions of a 30-year mortgage and cost inflation at 3.35%. I'm going to change the stock returns so that the difference over here of home ownership and stock investment is close to zero. And that number I've played around with was around 8.92%. So what this is saying is that over 30 years, if you had bought a house, you would be equivalent to someone generating a stock return of 8.92%. So that's quite an interesting thought. It does show that leverage does boost your return from 6.1% to, on average, 8.92% over the long term. So I'll leave this with you to play around with the assumptions. This is an interesting exercise, and I hope you guys enjoyed this calculator. If it's useful, let me know in the comment section down below. And I'll leave a link as well to Nigel if you do want to get in touch with a mortgage broker. I highly recommend him. And yeah, I'll leave a link to the calculator down below as well. Thank you guys all for watching. If you enjoyed it, be sure to hit like and subscribe. Until next time, take care.